Good evening, all. Okay, so let's make a quick revision first, and then we'll see the things for today. Okay, see, we started with this RBI. Yes, we started with this RBI. Okay, now RBI, it was established in 1935 under RBI Act of 1934. Okay, and this was formed on the recommendations of Young, Hilton Commission, and this commission is also called as Royal Commission for Indian Currency System. Okay, and when it was started in 1935, the capital, it used to be in Calcutta. Yes, later it shifted to Mumbai in 1937. Initially, it was a private company. Initially, it was a private company, and on 1st January 1949, we have nationalized RBI. So this we have seen, and then we have gone for the functions. Okay, so functions we have discussed 8, right? Yes, first one is issuer of currency. First one is issuer of currency, but the coins here will be issued by Ministry of Finance. Okay, second one, regulator of banking system. Regulator of banking system. Third one is government's banker. So here you need to remember section 22 of RBI Act. Yes, here you need to remember section 20 for central government, section 21A for the state government. Okay, so these 2 points, and then fourth one we have seen is public debt management. Public debt management. Okay, here you need to remember public debt management cell, which was created in 2016. And then fifth one we have seen is bankers bank. Bankers bank. Okay, and the seventh one we have seen is managers forex reserves. Forex reserves. What are the forex reserves? We have seen one is foreign currency. Second one gold. Third one is special drawing rights, and fourth one is reserve trenchy position. Reserve trenchy position. Okay, and then this is sixth one. This is sixth one, and this is seventh one. Seventh one, it manages the exchange rate of rupee. Exchange rate of rupee. Eighth one, it controls liquidity in the market. Liquidity in the market. Yes, it controls liquidity in the market. Till here we have done. Yes, till now any doubts online guys? Please let me know. Guys, if any doubts till now, I'll explain. If not the case, we'll see further. No? Sure, everyone? Great then. Okay. Now here, have you written any point? It controls liquidity in the market using monetary policy. Have you written this point? Yes? Okay. So, it controls, RBI controls the liquidity in the market. Liquidity in the market using monetary policy. Monetary policy. Okay, now we'll see what is this monetary policy. So keep heading as monetary policy. Next topic is monetary policy. Next topic is monetary policy. Hello everyone. Is everyone writing notes? See, Kausar Unisa. This is last day's class. Okay, from here you can write down the notes. Okay. Okay. So monetary policy is the policy. First, don't write anything. Okay. First, listen. Is the policy used by RBI to control liquidity, interest rates, and credit in the market. Okay. So first we need to understand this point, then I will make you write down the thing. See, what happens is, in an economy, we need to have a market equilibrium, which means demand must be equals to supply. Okay. If demand is greater than supply, okay, then what happens is supply is less. Okay, there are less number of beds, but there are more number of people, so demand is more. So if supply is less, demand is more, then obviously the prices will rise, and this we'll call it as inflation. On the other side, if demand is less than supply, which means there are more breads but there are very less people, so what happens is, the bread is a perishable good. Okay, the shopkeeper will tell you, okay, instead of one you take two. Okay, before I used to give it for 10 rupees, now I'll give you for 5 rupees only. Take it, because I mean, anyways, this is a perishable good, tomorrow it will not be lasting, so please take it for the half rate. Which means here what will be there is deflation will be there. The deflation will call it as recession. Okay, now when demand is maximum in the economy, which means there is more money in the pocket of the people. Now what we have to do is, as RBI, okay, RBI will decrease the money in the market. Then once money is not there in the market, then people will not demand. Demand will come down, and automatically the inflation will be controlled. Okay, so here RBI using monetary policy, RBI, it will decrease the liquidity in the market. Then automatically the prices will come down, because the demand will come down, so the prices will come down, so inflation will be controlled. Okay, on the other side, if there is a deflation kind of situation, which means people doesn't have money in their pocket, so they are not going to shops, so they are not demanding the products. So here what RBI will do is, RBI will take the money and it will throw it in the economy. So here RBI will increase the liquidity of the market. Once the market liquidity is increased, now people will have money in their pocket. Now they will demand will increase, automatically the deflation will be controlled. So here RBI will increase the liquidity in the market. So automatically deflation will be controlled. Deflation will be controlled. So this is how RBI will use the monetary policy to control liquidity. To control liquidity. And about the interest rates and all, I'll tell you, okay, later part. Okay, for now, note down this. Monetary policy is the policy used by RBI to control liquidity, interest rates, and credit in the market. And credit in the market. Yes, please note down and let me know in the comment section. Okay, so today what we will be doing is we'll do the quantitative tools of monetary policy committee, and then after the break we'll solve some questions. Okay, done. Remaining also please let me know. Done. Okay, now draw this diagram as well. Draw this chart. Draw this chart. Okay, fine. Draw this chart. Vaishnavi done? Yes, Unisa. Yes, it will be saved in the recorded videos. Yes, you can go through. Okay, done? See, now keep a note point and write down. RBI implements monetary policy through a committee called monetary policy committee. Monetary policy committee. Okay, RBI implements monetary policy through a committee called monetary policy committee. See, I'll tell you about this monetary policy committee. Then I'll give you some time to note down the things. Okay, see, monetary policy committee, it was formed in 2016. It was formed in 2016. It was formed in 2016. Okay. Now see, why all of a sudden in 2016, okay, government formed this monetary policy committee means, see, what used to happen is, see, initially everything is in the hands of RBI. Everything is in the hands of RBI. So to increase the repo rates, to decrease the repo rates, everything is in the hands of RBI. Okay. Now see, there are two functions, guys. Okay. In the RBI will be having governor. In the RBI will be having governor, and in the government will be having Ministry of Finance. Ministry of Finance. Okay. So these are the two guys who are responsible for the economy of our country. Okay. Now RBI's governor main role is to control the inflation. To control the inflation. To control the inflation. Okay. Now this guy, Ministry of Finance, his main role is to promote the growth. To promote the growth. Okay. So two different functions. One is RBI governor, second one is Ministry of Finance. RBI governor, what he'll do? He'll control the inflation. RBI, I mean government, Ministry of Finance, cabinet minister. So if he wants to be a great finance minister, then he has to promote the growth. Okay. Now see, only two things, guys. If we have so many governors, if somebody wants to prove as if he is the best governor in the country till now, then what he can do is he has to control the inflation in such a best way. Then he will be named as best RBI governor. Okay. If there is a finance minister, okay, if she is promoting the growth, example 10%, 12%, then he or she will be considered as best finance minister of the country till now. Okay. Now see, if RBI governor wants to control the inflation, then simply what happens is, when inflation will come, if in the market there is more money, if in your pocket there is more money, then you will create more demand. When you are creating more demand, then obviously the price of the product will increase, and that is called as inflation. Yes. So being RBI governor, okay, if you want to control the inflation, what you will do is you will decrease the money or liquidity in the market. Yes. Then demand will come down. Obviously the inflation will be under control. So here RBI governor will always try to decrease the liquidity in the market. Decrease the liquidity in the market. Okay. On the other side, what government is looking for? Government is looking for growth. When you will get growth? If there is more money in the market, then this money will leads to investment. Investment will leads to more number of goods and services, and that will give you the actual growth. So what these guys are looking for? These guys are looking to increase liquidity in the market. Yes, these guys are looking to increase liquidity in the market. Okay. But to increase or decrease liquidity, the powers are with RBI. The powers are with RBI. The powers are with RBI. So till 2016, okay, till 2016, only RBI used to decide. So RBI, it will never increase the liquidity in the market. It will always try to decrease the liquidity in the market, because its primary function is to control the inflation, not the growth. Not the growth. But for an economy, it is equally important to manage growth as well while you are controlling the inflation. So this is the key point. If this has to be done, the decision should not be taken only by RBI. It should be taken by both RBI and government. Okay. That's the reason. Okay. What happened is, monetary policy committee was formed in 2016. Okay. Now this committee has total 6 members. How many? 6 members. Before, only RBI used to take the decision. What should be the liquidity in the market? Whether it should be high, whether it should be low. Only RBI used to take the decision. But now what happened is these 6 members, it has divided into two groups. One is from RBI. RBI governor will be there. RBI governor will be there. Who is RBI governor? Sanjeev Khanna. Okay, Sanjeev Khanna. Second one is RBI deputy governor. Okay, in charge of monetary policy. In charge of monetary policy. Example, this time Poonam Gupta is there. Poonam Gupta is there. Okay, and third one is RBI's executive director. Executive director. Okay, Rajiv Ranjan is there. I'll tell you the names again. Okay, so the Rajiv Ranjan is there. Okay, and on Deputy Governor Poonam Gupta, I have made a video and I have uploaded in the YouTube. Okay, once check, because I mean there I have explained how governors and deputy governors are appointed for RBI. Okay, so this is about RBI contribution. Now government representation should be there. So now government, what it will do is it will nominate 3 persons. How many persons? 3 persons are appointed by government. Okay, now the tenure of these guys, ex officio post. Okay, till then he is governor, he'll be the member of monetary policy committee. Till then she is deputy governor, she will be the member of monetary policy committee. Until then he is executive director, he'll be the member of monetary policy committee. But for these guys, there is a defined tenure which is 4 years and not eligible for reappointment. Which means if a person I appointed as a member of monetary policy committee, okay, so my tenure is 4 years. After 4 years, after my resignation, I mean after my expiration of tenure, can I be appointed for twice? Second time? No. Okay, which means no reappointment. No reappointment. No reappointment. Okay, and what this monetary policy committee will do? Monetary policy committee objective is quite simple. Monetary policy committee objective is quite simple: to control inflation by keeping growth in mind. By keeping growth in mind. Okay, which means what happens here is there will be a target which is given for monetary policy committee. Okay, so target is 2 to 4% plus or minus 2% inflation. 4% plus or minus 2% inflation. Okay, so I have told you in the initial class, inflation is good for economy. It will create jobs. So up to certain percentage, inflation is really good for economy. After that, it will lead to a collapse of your currency system. Okay, but till a point, inflation is actually good for your economy. Now what happens is, here the target is given for monetary policy committee. So this target will be like, see, 4 minus 2 will be 2% and 4 plus 2 will be 6%. So the inflation must be between 2% or 6%. Inflation must be between 2% or 6%. Let's say if inflation crossed 6%, then immediately monetary policy committee, what it will do is, if it is plus 6%, more than 6%, then immediately monetary policy committee, what it will suggest is decrease the liquidity in the market. Liquidity in the market must be decreased. Then automatically inflation will be under control. Inflation will be under control. Okay. Second, if less than 2%, inflation is less than 2%, or inflation is in control, inflation is in control, but very low growth. Growth is quite less, very low growth. Then what happens is monetary policy committee suggests to increase the liquidity in the market. What MPC will suggest? MPC will suggest to increase liquidity in the market. Okay. So for every 2 months, for every 2 months, for every 2 months, they will check the market scenario. So for every 2 months, monetary policy committee meeting will be there. Okay. So example, in the Jan will be having a monetary policy committee meeting in the first week. Okay. And then February, March, second meeting will be March. Third will be, sorry, in the Feb monetary policy committee meeting will be there. And then in April, and then in June. Okay. Similarly, the last meeting will be in the December. Okay. So Feb, April, June, August, October, December. So the recent monetary policy committee meeting was happened in June 5th. Okay. So there everything is under control. So they have kept the things same only. They have kept the things same only. So for every 2 months the meeting will be having, and the main objective is to control the inflation by keeping growth in the mind. So this is all about monetary policy committee. Understood? Online guys, please let me know. Understood or not? Then I'll give you the notes. Yes, everyone? Okay, we'll write. Okay, now we'll write. See, keep main heading as monetary policy committee, monetary policy committee. Okay. Okay. Now write down. MPC is a committee. MPC is a committee under RBI. RBI to decide the benchmark interest rates, the benchmark interest rates. In bracket write down repo rate, MSF rate, STF rate, etc. Monetary Policy Committee is the committee under RBI to decide benchmark interest rates, repo rate, MSF, STF, etc. Okay. So it was formed in 2016 on the recommendations of Urjit Patel Committee. Okay, we'll read about all these committees. Narasimhan Committee 1, Narasimhan Committee 2, Urjit Patel Committee. We'll read about each and everything. Okay, so Urjit Patel Committee on the recommendations of Urjit Patel Committee. Urjit Patel Committee. Okay, because to maintain balance between inflation control and promotion of growth. Promotion of growth. Okay, no doubt. Please let me know once you're done with this, guys. Done? Done? Okay, now composition. Composition. Composition total 6 members. Total 6 members. Those 6 members further divided into 2 categories. 3 are from RBI, 3 from RBI, and 3 appointed by government. Okay, so who are those 3? One is RBI's governor. Okay, he is ex officio chairman. Ex officio chairman. Just like we'll see, right? Yes, vice president in article 64 will see he is ex officio chairman of Rajya Sabha. Similarly, governor is ex officio chairman of monetary policy committee. Okay, and then deputy governor, in bracket write down in charge of monetary policy committee. In charge of monetary policy. In charge of monetary policy. And the third one is executive director. Executive director. Okay, and these guys generally they are eminent economists in the country. Okay, basically from Delhi School of Economics, the professors, the heads you will take from them. Okay, and you appoint here as members of monetary policy committee. Okay, done. Okay, now we'll see who are those guys. Currently from RBI we have 3 members. Okay, so first one is governor. Yes, governor is Sanjay Malhotra. Sanjay Malhotra. And deputy governor is Poonam Gupta. Okay. And the third one is Rajiv Ranjan, executive director. Rajiv Ranjan. Rajiv Ranjan. Okay. And from the government nominated people, we have Ram Singh. Okay. And Saukata Bhattacharya. And third one is Nagesh Kumar. Dr. Nagesh Kumar. Okay. So these three are from government side and these three are from RBI side. Okay, I have told you these three positions are ex officio positions. Ex officio positions. Okay, and these three are appointed by government. Appointed by government. Saugata Bhattacharya. Okay, Saugata Bhattacharya. Then, okay, now see, now voting. See, now we have three members from RBI and three members from government. Okay, now what happens is voting happens for everything. Okay, let's say now the basic question is whether we have to increase the liquidity in the market or decrease the liquidity in the market, or we have to keep the liquidity in the market as same. Okay, now let's say these guys, okay, they have told that, I mean, we need to increase liquidity in the market. We need to increase liquidity in the market. And these guys told we have to decrease liquidity in the market. I mean, that's quite natural. Okay, now everybody will have equal value of vote. Everyone will have, everyone will have equal vote value, which means everyone will have one value of vote. Okay, so here this became tie. Yes, 3-3, it became tie. Now in that case, whenever there is a tie, then RBI governor will have casting vote power. Whenever there is a tie, whenever there is a tie, RBI governor will have, RBI governor will have casting vote power. Casting vote power. Okay, let's say this became 3:3. Now RBI governor will have one more vote again. Okay, normal vote anyways he has done. Now he will be having one more voting power, which is casting vote. Let's say now he went to this side, then this party will win. If he went to this side, then this party will win. And this kind of vote is called as casting vote. When there is a tie, then one vote will be given to some or the other person. Here we have given to RBI governor. So that kind of vote is nothing but casting vote. So remember, RBI governor has casting vote power in the monetary policy committee. Okay. Now tenure. Tenure, for the ex officio people, we won't check the tenure. Yes, so that's the reason tenure of government appointed members. Government appointed members. What is the tenure? 4 years. Not eligible for reappointment. Not eligible for reappointment. So 4 years tenure and not eligible for reappointment. Okay, guys, in between, if you have any of the doubts, you can ask me, okay, in the comment section. Done, Vaishnavi? Good. Super. Okay. Now we'll see meetings. We'll see meetings. Meetings will be 6 times. Okay. So in the monetary policy clause, what they have written is minimum 4 times in a year. Minimum 4 times in a year. Minimum 4 times in a year, which means quarterly. But now generally they are meeting 6 times in a year, which means after every 2 months. Okay. So in practice 6 times in a year, 6 times in a year, which means for every 2 months, one meeting. For every 2 months, one meeting. For every 2 months, one meeting. Okay, and objective I have told you. Objective of MPC to control the inflation, by keeping growth in the mind. By keeping growth in the mind. By keeping growth in the mind. Objective. By keeping growth in the mind. Okay. So this is all about monetary policy committee. Any questions here? Simple. Done? Done? Okay. So simple monetary policy committee. Monetary policy committee 2016 on the recommendations of Urjit Singh Patel committee. Okay. It will be having 6 members, 3 from RBI, Sanjeev Malhotra, Poonam Gupta, and third one is Rajiv Ranjan. Okay. And from the government side, we have three things, 3 persons. One is Ram Singh, Saugata Bhattacharya, and Nagesh Kumar. Okay. So these are the 3 persons from government side. Okay. We have seen this. And then equal voting value. Voting value, same voting value. Same voting value. But RBI governor has casting vote power. RBI governor has casting vote power. Now we have seen for every 2 months there will be a meeting, and the objective is to control the inflation by keeping growth in the mind. Okay. Now to control the liquidity in the market, RBI will to use 2 types of monetary policies. Okay. So types of monetary policies. Keep heading as types of monetary policy. Types of monetary uh, is this Srija? Okay, note down and let me know, Srija. Srija, please note down and let me know. Today we have to cover so many things. Done? Super. Now keep heading as types of monetary policies. Okay. So there are two types of monetary policies. One is contractionary monetary policy. Second one is expansionary monetary policy. Simple. See, contractionary monetary policy means decreasing the liquidity in the market. When you are decreasing liquidity in the market, it will contract, the economy will contract, and this kind of policy is called as contractionary monetary policy. On the other side, if you are increasing the liquidity in the market will expand, the market will expand, and such a kind of monetary policy is called as expansionary monetary policy. So here liquidity will increase. Here liquidity will increase. In simple words, when contractionary monetary policy will be used, when it will be used, when it will be used, when there is a recession in the market or inflation. See, contractionary monetary policy. If inflation is there, then monetary policy will committee will enter into the picture. It will decrease the liquidity in the market. So during inflation. So this will be used during inflation. So when this will be used during deflation or recession, during recession, or inflation is under control but there is low growth. Inflation is under control but inflation is under control but low growth. In such a kind of scenario, we'll use expansionary monetary policy. Understood? Two types of monetary policy. One is contractionary, which means you will take out the liquidity from the market and you'll contract the market. On the other side, you'll put more money into the market and you'll expand the market. No, central government will not appoint 3 members by Ministry of Finance. No. There is a selection committee and there is a appointment committee. Now what this selection committee will do is, selection committee will check the entire country from the field of economics. Okay, they'll check for the experts in the entire country from the field of economics. Okay, now that will suggest the names to appointment committee. Okay, now what this appointment committee will do is, appointment committee will choose or pick somebody from the recommended names, and that they will submit to this council of ministers. Now council of ministers will appoint those 3 members, or cabinet ministers. Okay, cabinet will appoint those 3 members. Understood, guys? Appointment. That's the reason I'm asking you. We have a video on this Poonam Gupta. Okay, still she is anyways RBI deputy governor. So please watch the Poonam Gupta video. There I have explained in detail. Done? Done? Now, see, we'll see the tools how RBI will control. To control liquidity in the market, to control liquidity in the market, liquidity in the market, RBI uses two types of tools. Two types of tools. One is quantitative. First, I'll tell you the tools and then I'll let you know the difference between quantitative and qualitative. Tomorrow, I'll let you know. Okay. So, quantitative tools. And second one is qualitative tools. Qualitative tools. Okay. So, first, write down this. I'll make the list of quantitative tools and then I'll give you the list of qualitative tools and then I'll take out each and every tool in detail. Okay. No doubt. So to control liquidity in the market, RBI uses RBI uses RBI uses two types of tools, quantitative tools and qualitative tools. RBI uses two types of tools, quantitative tools and qualitative tools. Then first note down quantitative tools. Okay. So no worries. After the class, you will remember each and every tool. But for now, please note down the tools, quantitative tools. Okay. So quantitative tools, we have 8 tools. One is CRR. This we have already read. Cash reserve ratio. Cash reserve ratio. Second one is SLR. Statutory liquidity ratio. Cash reserve ratio. Statutory liquidity ratio. Okay. Now these are new for you. Third one is bank rate. Okay. Fourth one is repo rate. Repo rate. Fifth one is reverse repo rate. Reverse repo rate. Sixth one is standing deposit facility rate. Standing deposit facility rate. Seventh one is marginal standing facility rate. Marginal standing facility rate. Okay. And the eighth one is open market operations. Open market operations. Open market operations. So total 8 tools. How many? Total 8 tools. Okay. On the other side, we have qualitative tools. Okay. On the other side, we have qualitative tools. So qualitative tools, we have 5. One is margin requirement. Second one is consumer credit regulation. Third one is credit rationalization or rationaling. Credit rationaling. Fourth one is moral suasion. Moral suasion. And fifth one is direct action. Direct action. So here we have 8 tools and here we have 5 tools. Okay. By using these all tools, RBI, or to be specific with you, Monetary Policy Committee will control the liquidity in the market. Will control the liquidity in the market. Done? See, okay, no worries. Each and every tool will be in your mind after this class. Okay, so till then, please wait. What's there? Star 24. Moral suasion. Moral suasion. MORAL SUASION. Moral suasion. Okay? Moral suasion. Understood, Sudhir? Sudhir, I'm checking your answers, and Nani, thanks. You are also sending your answers. Remaining Srija, you are sending. Okay, Vaishnavi also sometimes. Please, everybody. Srinidhi and all, I mean, these students, anyways, they are sending. Okay. Done? Fine. So we'll start with the first tool, which is cash reserve ratio. This we have already read before. CRR. What is CRR? It is mandatory for every bank to keep certain percentage of their NDTL with the RBI, and no interest will be given on this part. Yes? So CRR is mandatory for every bank. For every bank, CRR is mandatory for every bank to keep certain percentage of their net demand time liabilities, NDTL, with RBI. Okay, so here no interest will be provided. No interest will be provided. Okay, now see. Now, before I have told you about this, but then I haven't told you this is a monetary policy tool. Now I'm telling you this is a monetary policy tool, which means by using this, you can control the liquidity in the market. How? We'll see. See, example, this is a bank. Okay, now forget about SLR. There is no SLR. Okay, now this got deposits from the people. Okay, how much? 100 rupees. 100 rupees. Now, this is the NDTL of the bank. This is the net demand time liability of the bank. Now, we have CRR 4%. How much? 4%. Now, what happened is, out of 100 rupees, 4 rupees, it has to kept aside as CRR, and remaining 96, it is a loanable amount. Loanable amount, which means this, it can provide people as loan. Yes. Now what happened is, now there is inflation in the market, which means there is huge money in the market. People are having so much of money in their pockets. Now they are demanding more. So RBI, what it has to do, it has to control the liquidity, which means it has to decrease the liquidity in the market. Yes. Now what RBI will do is, see, RBI instead of 4%, RBI instead of 4%, it will keep 10%. It will keep 10%. Now, out of 100 rupees, they have to kept 10 rupees aside. This is not the case now. This is the case. 10 rupees as CRR. Okay. And now only 90 rupees is there as loanable amount. As loanable amount. So before there are 96 rupees in the market, but now only 90 rupees in the market. That's how it can decrease the amount. Okay. Let's say tomorrow there is no growth or deflation is there. Then what happens is RBI, it will cancel this 4%, it will go to 0%. Now, before 96 rupees used to enter into the market. Now, how much will enter? CRR 0. So, obviously, 100 rupees is loanable amount, which means, again, here we have two things. One is inflation, and second one is deflation. If inflation comes, if inflation comes, we need to suck the money in the market. Yes. So what RBI will do is RBI will simply increase CRR. RBI will simply increase CRR. Then what happens? Liquidity in the market will come down. Okay. Inflation will be controlled. Inflation will be controlled. On the other side, if we have deflation, which means there is no money in the market, then RBI has to push the money into the market. Now what RBI will do? RBI will simply decrease the CRR value. The money entering into the market will increase now, which means the liquidity will increase. So the deflation will be controlled. Deflation will be controlled. So in UPSC, what he'll simply ask you is, if there is deflation kind of situation, okay, CRR will be increased, CRR will be decreased, CRR will remain constant, no effect. Okay, CRR will be decreased. Okay, so this must be your answer. So first note down these points and then I'll turn the page, then you can note down those two things. Okay. Okay, done everyone? Note on this. Note down. Okay, Vaishnavi, please note down. No, control is not equals to market equilibrium. Market equilibrium is the ideal situation that nobody can achieve. Okay. So here control means whenever inflation kind of situation is there, we'll try to control the prices. Okay. And whenever inflation is in control but there is no growth, then what happens is we'll try to provide loans at cheaper cost. Then investors will take more loans and they'll invest in the economy and they'll promote the growth. Okay. So equilibrium, market equilibrium is the ideal concept that nobody can achieve. Okay, even if we are achieving also in a month merely one day, in a year merely one day. Okay, so obviously a partial impact will be there. Okay, we'll try to control only inflation. Okay, fine. Remaining also, if you have any questions, you can ask me, guys. Done. Okay, now we'll see SLR, the second tool. Okay, the second tool is SLR, statutory liquidity. Statutory liquidity ratio, SLR. SLR means SLR is mandatory for every bank to keep certain percentage of their NDTL in the form of government securities. Okay, so SLR, it is mandatory for every bank, for every bank to keep certain percentage, certain percentage of their NDTL in the form of government securities, government securities. Okay, in the form of government securities. Okay, so here they can earn some interest. Yes, they can earn interest because they are investing on government bonds. Obviously they'll get 6 to 8% of the interest. Okay, so here they can earn interest. Okay, now see, this we have already discussed. Now as a monetary policy tool we haven't discussed this. So now as a monetary policy tool, see, now this is the bank. Okay, now it got 100 rupees as deposits, as deposits. So 100 rupees NDTL, 100 rupees NDTL. Now we have already kept TRR 4%, which means 4 rupees. SLR is 18%. I'll show you these values today. Okay, SLR is 18%, so 18 rupees we have kept aside. So remaining is, this is 22 and we are left with 78. 78 rupees, this is loanable amount. Loanable amount. Okay, let's say if inflation is there in the market, which means there is huge money in the market. Now RBI has to suck the money from the market. Now what it will do is, it can control CRR that we have already seen. Okay, here I am keeping CRR as constant. Okay, now this is constant. Now let's say from 18% it has increased SLR to 30%. SLR to 30%. Now what happened is 30 rupees plus 4 rupees they'll keep as reserve. Remaining is how much it is? 66 rupees. This is loanable amount. So before 78 rupees entering into the market, but now only 66 rupees is entering into the market. That's how it will control the liquidity in the market. In the second case, let's say if there is deflation, then it will decrease SLR to 10%. Okay. Now what happened? 10 rupees plus 4 rupees, it became 14, and we are left with 86 rupees. This is loanable amount. This is loanable amount, which means before 78 rupees is entering into the market, but now it is 86 rupees which is entering into the market, which will increase the liquidity in the market and the demand will rise, deflation will be controlled. Okay. So to write these things again, so if there is inflation, SLR will be increased, liquidity in the market will come down, and inflation will be controlled. Inflation will be controlled. Okay. On the other side, if deflation is there, deflation or recession is there, SLR will decrease, liquidity in the market will be increasing, and inflation will be, deflation will be controlled. Deflation will be controlled. So this is how it will work as a monetary policy tool. Okay, you're done with this page? Everyone, this page is done? If this is done, note on this. Srija, you're done with the previous page? Yes? Okay, okay. Please note on this. I'll get some questions tomorrow, okay, on this as well. Done? Okay, fine. Note down this. Done? Okay. Now, what's the time? Sir, are both SLR, CRR can be imposed at once or they may be imposed accordingly? I mean, it depends on RBI, guys. Okay. But generally, SLR ratio will be fixed. Okay. The CRR ratio, sometimes it will be 4.5% and sometimes it will be 4%. As of now, it is 4%, but recently, before 3 months, it used to be 4.5%. 3-4 months it used to be 4.5%. So in my knowledge till now I haven't seen SLR it increased or decreased. It was always remaining in 18% position only, but they are using the CRR as a tool. Okay, SLR they can use, but they are using only CRR as a tool. Okay, now what we can do is, like now it is 6:15. Okay, so I'll teach you remaining tools after break. Okay, so break till 6:40. Okay, come back at 6:40. Again 1.5 hour or 1 hour 20 minutes lecture will be there. We'll end by 8 o'clock. Okay, so take a break till 6:40. Remaining tools we'll see after the break.